Something big is shifting in global finance. And if you're still treating US Treasuries as the ultimate safe haven, you might be playing by a rulebook that no longer applies. Today we're going to talk about something deeper than just interest rates or recession fears. We're going to talk about the breaking of the dollar system, the very foundation of how global money has worked since 1973. And yes, the cracks are already forming. For decades, the US dollar and US government bonds were the core of what investors called risk-off assets. If markets got shaky, you bought dollars. You bought treasuries. End of story. But today, that logic is starting to fail. We're seeing breakdowns in long-standing correlations across asset classes. And the idea of what's truly safe is being redefined, not just by traders, but by policymakers and global capital flows. So let's break this down. What's happening right now? First, US Treasuries are losing their grip as the go-to safe asset. Not because they're risky in the traditional sense, they'll still pay you back. But because the macro environment has changed so drastically that holding them feels less like safety, and more like exposure. The market is realizing that if inflation gets structurally stuck above 4%, and policy responses don't come fast or credible enough, US debt loses its magic. Investors are no longer running to treasuries by default. Instead, they're reallocating into German Bunds, UK Gilts, and most notably, gold. Why? Because of how US policy is evolving, especially under Trump. Over the last few weeks, we've seen a clear pattern in how Trump responds to market pressure. If the bond market pushes hard, if yields spike, he pulls back. That's the real feedback loop. That's the reaction function now. And we're watching that play out in real time. Right now, markets are testing that policy edge again, pricing in the potential for a Trump rollback. But here's the twist. If he does backtrack, and the dollar sees a temporary technical bounce, that could actually be a setup for the next massive wave of dollar selling. Why? Because the trust in the dollar system, built over 5 decades, is fading. This isn't a panic call. It's structural. The post-1973 international dollar-based system is starting to fragment. And no, tariffs alone didn't break it. But they weakened the edges. As global economic imbalances worsened, as inequality and political polarization grew, pressure on the dollar's reserve status mounted. We've been warning about a tail risk scenario, a breakdown of the dollar system, for nearly a year. And now? That scenario is becoming more mainstream. Let's talk mechanics. For the dollar system to truly break, 2 conditions need to be met. First, the Fed must lose its independence, either politically or operationally. We're already seeing signs of this. Recent policy guidance is sounding more and more aligned with fiscal objectives than monetary ones. Second, capital controls, what we call the Mar-a-Lago doctrine, must become real. If Trump's team starts limiting foreign capital inflows into the US, or placing hard restrictions on capital mobility, the system fractures. And here's the scary part, both conditions are no longer hypothetical. We're already halfway there, and policymakers are openly discussing the other half. Even if some sort of tariff deal is struck between the US and China, let's say average tariffs settle around 30%, the damage may already be done. If China responds with a yuan devaluation, that will likely prompt even more aggressive capital control rhetoric from the US, and once those words turn into policy, we're not just talking about currency volatility anymore. We're talking about a global liquidity crisis. There is no deep enough alternative market to absorb all the USD assets in the global financial system. That's not theory, that's math. Some traders may think, okay, what if Trump walks it all back? What if he pivots, markets calm, and the dollar bounces? Sure, a bounce is possible. But we believe that rebound will be a massive short-selling opportunity. Because the long-term trust in the dollar system is breaking down. This isn't about interest rates or next quarter GDP. This is about whether the global economy still wants to store value in the same system it's used for 50 years. And increasingly, the answer looks like no, so what should investors do? Here's the key, preserve capital first. Forget chasing yield. This is about safety, not speculation. That means looking at classic alternatives, sports metal gold, still one of the only non-sovereign assets that holds up in regime shifts. German Bunds, rising as a new safe haven in a post-dollar world. United Kingdom UK Gilts, still backed by deep capital markets and stable legal systems. Yen no Japanese yen, possibly useful, but Japan's fragile financial system adds risk. These assets won't replace the dollar outright. But they can offer shelter in the transition to a multipolar currency world, where no single currency dominates. And yes, that world is coming. You can already see the early stages in trade deals, central bank reserves, and global capital flows. Now let's be clear. This won't be a straight line. There will be counter rallies. Dollar squeezes. Headlines about deal optimism, but the long arc is bending away from the dollar and toward a new order. And if you're still building your portfolio around the idea that treasuries are untouchable, you might be preparing for a world that no longer exists. So, stay sharp. Watch policy signals, not just from the Fed, but from the White House. Track how capital is flowing, especially who's selling dollars, and who isn't buying anymore. And above all, prioritize preservation. In this environment, return of capital matters more than return on capital. The dollar system isn't gone, but it's cracking. And the next few months could determine whether it bends or fully breaks. Let me know in the comments, are we at the end of the dollar era? Do you think gold and bunds can replace USTs in a crisis? Or is this just another panic cycle? Hit like, subscribe, and tap the bell for more deep dives like this, because the world's monetary system might be changing faster than most people think. And you don't want to miss it.